De ello vamos a hablar, se lo decía antes de publicidad, de la mano de Oxford Economics, Michael Pearce. Good evening.
Hi there.
Taking into account, Michael, the PMI data we just received today, at what point is the US economy?
So I think the US economy is in still pretty good shape. Obviously, the figures we saw today highlight that in the strength of manufacturing starting to come back. That's the sector where we've seen really pretty weak performance over the last few years, thanks to higher interest rates. So really the loosening of financial conditions that we saw over the past 3 months beginning to feed through to a bit of a rebound there. Obviously, the services index fell slightly, as you noted, but overall, I think the services side of the economy is still holding up relatively well. This is still a relatively resilient economy, driven, of course, by a pretty resilient consumer. So we've got still a very strong labor market in the US that's fueling income gains, and consumers are feeling confident enough to go out and spend those incomes. So unless we see the labor market suddenly turn over or suddenly weaken, I suspect the economy continue to grow at a steady to solid pace over the rest of this year.
But manufacturing then is a risk for the US economy.
Well, manufacturing, I think the prospects are starting to brighten, really. I think that the fall in interest rates that we've seen over the past few months are beginning to feed through to a bit more optimism. We're beginning to see demand from the rest of the world brighten too, particularly as prospects in the rest of the world, including in Europe, begin to pick up. So manufacturing is a sector, I think, where we could start to see signs of stronger growth, particularly in the second half of this year. And also a big part of that, not just a cyclical story, but I think a new structural story as well. I think a lot of the strength we're seeing are in areas where there's been a lot of legislation targeting, for example, the EV supply chain, targeting semiconductor manufacturing. We saw a big wave of factory construction over the past 18, 24 months, and we're now starting to see that in the actual production data as some of those factories begin to come online. So I think that's going to be a longer-term story playing out over the next few years.
So has Powell inflation under control?
So this is the thorn in the economy's side, is that inflation remains too high. Obviously, the past few months' data have been unhelpful for the Fed. The officials have acknowledged that. I think as a result, we're likely to see the date at which the Fed begins to cut interest rates pushed out. At Oxford Economics, we think that's not going to happen until September. But really, when we look under the hood at the details of inflation, I think the last few months are going to prove to be a kind of aberration rather than a sign of a new upward trend in inflation. Really, when we look at the underlying drivers, the Fed is most concerned about what's happening with services inflation. And all the leading indicators suggest that rental inflation is still decelerating from here. And broader services inflation is driven by the labor market. And although the economy is still creating a lot of jobs, what we've seen is an improvement in the balance between demand for workers and supply of workers. As we've had higher interest rates, we've had a big wave of migration into the US, and also signs that that balance between the two are coming into better alignment. That's helping to drive wage growth lower. We're still seeing signs that wage growth should be easing from here. And I think that will feed through to lower inflation readings in the second half of this year. So while it's taking a bit more time for the Fed to start loosening interest rates, I do think they will still be in a position to lower interest rates, perhaps in September of this year.
Is the situation different in Europe?
So the situation in Europe is different because we're seeing faster falls in inflation. The economy was never as hot as it was in the US, so you don't see that inflationary pressure as much from the labor market. I think also as the legacy of the energy crisis in Europe fades, we're seeing that translate into much faster falls in headline inflation. So I think that combination points to maybe sooner rate cuts in Europe. So we'd have the ECB beginning to cut in June. I think they've signaled that quite clearly. And I think thereafter, you could get a faster pace of rate cuts in Europe. So I think comparing the US to Europe, I think the stronger economy, more resilient inflation in the US means rates are going to remain on hold higher for longer, and of course I think that means there's going to be some more upward pressure on the dollar as well, particularly against the euro.
Which is the main risk here, if inflation is not?
So I think the main risk in the very near term is that inflation remains higher than expected for longer. I don't think that would cause the Fed to reconsider and begin to raise interest rates again, as a number of people have noted over the last few weeks. But I do think there's a risk that the first rate cut is delayed even longer. Really, a lot of the inflation risks are still skewed to the upside. We've still got a strong economy. I think geopolitical risks still linger over the economy if we saw a big rise in oil prices, or maybe renewed flare-ups in shipping costs, which put more upward pressure on goods inflation. I think the Fed would probably need to respond to that by holding rates on hold for a longer period. So I think the risks in the near term are that inflation remains higher. I think over the longer term, the US economy is very sensitive to what happens on the supply side of the economy. We've seen this big rise in migration. We've seen a rebound in productivity growth. And that's been crucial for describing how the economy has evolved over the last 18 months, because we've had this combination of falling inflation and stronger economic growth because the supply side has expanded. So I think any signs that story was beginning to change and that the supply side of the economy was weakening, maybe because migration's falling back, because of a normalization in productivity growth to more modest pace, I think that would also signal a concern. But that could go in either direction. We could see weaker productivity growth, which causes inflation to remain higher in a weaker economy. Or we could, on the other hand, see a period of much stronger productivity growth over the next few years, which I think would really raise the risks, raise the prospects of a soft landing.
So attending to oil prices, for example, should we be worried about geopolitical tensions?
Well, I think you've seen a very muted reaction in financial markets from the latest escalation the other weekend. I think that's, seems to make sense in the context of this doesn't seem to be the beginning of a much larger escalation. I think if we saw more, a wider regional conflict, which risked interfering with global oil supplies, I think that's the key channel for economic contagion, that we see a sharp rise in oil prices. I think it's something that we have to be vigilant of. I think it's very difficult to predict. But so far, it's kind of been it remains in the background. I don't think it's a major factor for now. But obviously, if we did see that major disruption and a big rise in oil prices, it would be something that policymakers would have to react to.
So, Michael, thank you so much. Good evening.
Thank you.